Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, April 1, 2015. Inside the numbers tonight, we are going to discuss the SPDR and the EMini contract. We'll do crude oil. We'll talk about the gold market, which is interesting. And we'll discuss interest rates and the bond market. And let's get rolling. We have some interesting stuff. So now we're going to start out today with a 60-minute chart or an hourly chart of the EMini contract. Why? Because I want to show you what happened last night. It was very interesting. Let's go back to yesterday's video and yesterday's close. And if you remember, the first thing I did yesterday, and I made the video early, and I'm doing it again tonight, and it's interesting. I don't usually do the video till much later, and the reason is because I like to go over everything, and I like to get my my numbers right, and all the research done, and all my indicators looked at, and I do my calculations, and I provide you with the best possible information that I can provide. And last night and tonight I have something to do at night, so I actually am making the video shortly after the market close. But last night at 9 o'clock, remember I said it was a bad close. Okay, so that was fresh in my mind. It was a bad close. It didn't look good. At 9 o'clock last night, look what happened. The S&P E-mini contract, so the futures, dropped almost about 30 points, okay, inside of an hour or in an hour. And that's a big deal. That doesn't happen very often. And what happened was we remained relatively weak today. But what happened was we climbed back all the way, okay, all the way, what time is this? All the way to 6 o'clock in the morning. Okay, 6 o'clock in the morning we closed at 2059.50. What was the high of this big red candle here, this down candle? 2059.25. And what was that other one? 2059.25. And the close 2059.50. Well, actually, that was a bullish close, and it didn't happen, and it went back down all day long, and then it just chopped around all day. And we tried to do a retest, and maybe made a higher low. We'll have to see what tomorrow brings. But I thought it was interesting. It was a bad close, and the S&P E-mini dropped 30 points overnight at 9 o'clock at night. Pretty interesting stuff. So what do we have today? So let's take a look. Let's go over to the SPDR. And this is also a bearish pattern on the hourly chart, okay? You're below all the moving averages. You're going sideways all day. Only today you had what I would call a good close. So it was the opposite effect of yesterday. Today you had weakness and you had a good close. Yesterday you had a bad close when it looked like the market was starting to firm up. And today they jammed them right up into the close. In fact, if you look at the 10-minute chart, and we're actually up in the we're up in the aftermarket trading in the SPDR as well. But right here, you see in the 10-minute chart, they jammed it right up into the close, 205.75, and the SPDRs are up another 25 cents after market, right basically into the 50-period moving average. But you can see that's a positive sign that there were buyers at the end of the day, or they may have been short coverers. That's possible. Anything's possible, but I still look at money flow, and when money is flowing into a market, that's bullish. Any way you look at it, it doesn't really matter what the reason is. So we'll have to see what tomorrow brings, but this is the day before a holiday weekend. Normally, you won't get a lot of selling pressure the day before a holiday weekend. We'll have to see what tomorrow brings because, you know, if you look back at this year, we've had a lot of down Fridays. You know, I don't know how many. I didn't count them up, but I'm going to do that. But down Fridays have been, you know, more than half, I think. And in 2014, it was the opposite effect. There were hardly any. So tomorrow's kind of like a Friday. So we'll have to see what happens. But normally we get a higher close into a long holiday weekend, and that's kind of what I'm looking for. And I'm also, as you know, let's go over to the daily chart, okay, because we want to get the 30,000-foot view here. The market held at 204. So far, so good, okay? If this becomes a higher low, then maybe we can take off. And if we can get above these two moving averages that are beginning to converge. The blue is the 50 and the red is the 20. If we can get above, let's call it, 207.60, it'll change tomorrow because this number will change on a closing basis, then we're in business. But right until that happens, the market's going to be kind of in a no man's land in the middle of the range, similar to what we found with the bond market. Well, I talked about it last night. We were in the middle of the range. We were in no man's land. We'll talk about that later. But I am looking for higher prices into April, and I think April should be bullish, and we should have more bullish than just April, but April should be bullish. So we're looking for the market to begin to firm up right here, right now. Okay, that's what we're looking for. All right, let's move over to the gold market. And gold was interesting today because we had a big up day. Remember what I was saying? This was all buying territory. I must have said it 4 or 5 times over 4 or 5 days. I said, as long as we get down to 1175, 1170, 1180, those are pullbacks and those are meant to be purchased. Those are on sale. What happened today? The sale closed, and now there are back to retail prices at 1204. So, we want to buy stuff on sale. We don't want to buy retail. This is when we buy down here, we buy down here. We don't buy them up here. I mean, if you want to buy and hop on, that's up to you, but the probabilities of a profitable trade are reduced from those that entered the trade here for obvious reasons. Okay, but there are higher prices coming in gold. It's just not all going to happen at one time. You may have a halfway backfill tomorrow, right? You may go back down $10 tomorrow, and if you're in GLD, that's down $1, and now you're feeling pretty bad about it. So that's why we buy on sale. We don't buy up here. So I think 2040 is the next target. 1240 is the next target, and that's what we're looking for. So feel pretty good about gold. It's doing everything that we said it would do. Let's go over to oil. Same routine. Oil, what I've been telling you, I'm going to go to the intraday or the hourly chart. In oil, I can't get to the hourly chart. Let's go. All right. So oil, what I was telling you was, as long as oil, I told you this 3 or 4 times, as long as oil stays above $47 on a closing basis, that's the May crude futures contract, you're in good shape. Bullish contract, right? As long as it's above 47. What was the low today? 47.24. I thought it was lower. I thought it was actually 47.05. There it is. 47.05. Low today. Okay, held it, and look what happened. We took off to the upside, and from that point, from 47.05, the market went to $50.45. Okay, that's pretty incredible. $3.50 pop in the matter of 1, 2, 3, 4, 5, 6, 7, 6.5 hours. 6.5 hours. So basically, the equivalent of basically a trading day. Oil went up $3.50 from the low. So here, how do you trade that? If you're hearing me say $47 as long as the market remains above, and when I say remains above closing, it's first it's hourly and then it's daily closes. So we close the hourly above 47, you could take a trade. Where's your stop out? A close hourly below 47. Yes, you might have to risk some money, but this is the risk business. That's the business we're in. So I see it down at 47.05. It's hanging. The hour closes. It's whatever price it is. Maybe it's 47.50 at that point. It doesn't matter to me. It's just I'm increasing the odds. I'm increasing the probability that the trade becomes profitable. So in that case, I'm going to maybe make less profit, but I'm going to do it with a higher probability. I want that. I like that. Don't you? So the hour closes and I hop on. Where's my stop out? My stop out is a close below $47 on an hourly basis at that point. That's an intraday trade, at least for now. Okay. So now I'm in the trade and it starts to move up. What happens? It starts to move up. I put a break even stop or I put a trailing stop in. So as the market increases, my stop begins to increase with the market. The market gets up to $50.45. Let's just say, for argument's sake, my trailing stop was $1. Okay? So now, where's my stop out? Once it got to 50.45, I'm guaranteed at this point that I'm going to see 49.45 as the low print that I can sell at. Okay? I can't do worse than 49.45 on a stop out basis. So what does that mean? It's $2.5, $3 gain with no sweating it, right? Because once I have my stop in, I'm basically just a spectator. I'm letting the market stop me out. What I've done is I've taken my emotions out of the trade. I let the market stop me out, and that's the way to trade it. All right, little trade school there, little trade lesson. Let's go over to the bond market. This is the bond market. Let's go over to TLT. It's easier to talk about TLT. Okay, so we'll go to the daily chart, and TLT had a nice day today, if I can get over there. Okay, so TLT had a nice day today. It was up over $1. And, last night I said we're in no man's land here. I don't know whether it's going to go up or down. Well, this was the up one. But I wasn't in it because we're out, right? We were out up here. And from down here, we're out up here. I'm not interested until I see some kind of a pattern develop that tells me to get into the market. So until that happens, I'm out. Let's see. If you want to flip it around, I know a lot of people look at the interest rates. Where's the low in interest rates? Well, right now, I would say that your low is about 1.8. Any close below 1.8, you really start to get into the camp of looking down here at the 1.6s, 1.7s, but you're already close there anyway. But I think that I think this will hold. So my point is that how much more upside can there be in the bond market right now? Later, who knows? Right now, I don't think there's much. So from 186 or 187 down to 182 in that neighborhood, I'm not interested in that trade. It's just not for me. It's for some other people. It's just not for me. It's not necessary. So what I see here is a no trade. I don't know. I don't have a definitive high probability directional trade in the bond market right now. So when that's the case, we just leave it alone. There's nothing else to do. Okay, so I think that's it for tonight. That's a wrap. Oh, you know what? I didn't talk about GDX. Let's talk about GDX. Let's circle back to GDX. Well, it's the same as gold. And remember last night, and I know just this week I started talking about GDX, and I said if you wanted to hop on, you just put your close below here or here. The more aggressives here, the less aggressive here, if you will, or the less risk tolerant here. And you could have bought it anywhere in this area, and you would have had a nice pop today. It was up, what was GDX up? 96 cents, I think it says. So that's a pretty good pop. There's more upside with gold. And if you get a gold up day and a market up day, you're going to get extra momentum, extra juice, extra propulsion out of GDX. So I'm glad anybody that was able to hop on this trade with this stop out in mind did well. So now what you do is you trail your stop. You put a stop at worst case break even. Okay, so you guarantee yourself a winning trade. Some folks will want to take half off and trail your stop. Some folks won't want to take half off, but you at least have a stop break even or in the money and or trail your stop. And that's how you play. That's how you play this as a business rather than the hope game. All right, folks, I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.